Good afternoon everyone. I am Aashna from semester 2. Today I am going to present a presentation of cost of capital. Cost of capital. Cost of capital is a very important concept comes in the financial management. It comes under a capital structure. So cost of capital is a minimum return a businessman expect from investing. So wherever we take loan or investment comes in business, we consider a return. So let's move on to the next slide to understand it well. Cost of capital, the foundation of financial decisions. Cost of capital minimum return is equal to minimum return a company must earn. As I have already mentioned, it represents the cost of funds, which is loan plus investment, which is used for investment decisions, project evaluation and business expansion. Components of cost of capital. Cost of capital have different components which plays important role while calculating cost of capital, which is cost of debt, interest paid on loan, example bank loan at 18%, cost of equity, return expected by shareholders and which is higher risk is equal to higher return. See, cost of debt. We will understand first what is cost of debt. So it is a interest calculatable on a cost of capital. So here is a point that there is a reduction like tax deductible. Then the cost of equity, where return is expected by shareholders, where it is higher returns expected by shareholders, where there is higher risk also. So we will see how a real life example will impact while calculating cost of capital. So opening a cafe, we are opening a cafe where is total the investment is 10 lakh, from which there is a 6 lakh as loan and interest rate is 10% and tax rate is 30%, which is assumed. You can see in the solution we have calculated on the loan amount which is calculated on the cost of debt, which has been raised on cost on debt. So the loan amount is 6 lakh, where interest rate is 10% and tax is which is assumed as 30%. So after calculating all this, we can see that after tax deduction there is a total return of 7%. When we have raised it on cost of debt, so we have gained that there is 7% of return. So the next slide will be represented by my classmate Uhana.
Hello everyone, my name is Uhana Khan from MBA second semester. Now I will explain why cost of capital is important. First, cost of capital helps in investment decision by acting as a benchmark. It helps business decide whether a project will generate sufficient return. Second, it is widely used in capital budgeting techniques such as NPV and IRR to compare and evaluate different investment opportunities. Third, it plays a key role in determining business profitability by comparing the returns earned with the cost of fund. Fourth, it helps companies to choose most suitable source of finance, whether debt or equity, based on cost and risk. Fifth, lastly, it improves financial efficiency by ensuring that funds are used in the most optimal and productive way. So, we can conclude that cost of capital acts as a benchmark for making effective and smart financial decisions. Thank you.